It's a real pleasure to be speaking with James Mworia, CEO of Centum. And
Fantastic.
James, I think we're in the right place to be speaking in a cigar lounge. I'm half expecting you to break out with a cigar after releasing your very, very good full year results.
Yeah. Thank you, Elkan.
And thanks for making the time
Thank
today.
you, it's a pleasure.
I was thinking back, before you started presenting, I was looking back at that presentation you made at MindSpeak in 2008.
Yes.
James,
Yeah.
and you actually forecast in so many ways where you were going to be a decade later. And I can't think of any examples of people who've done that. So let me congratulate you.
Thank you. You've been very fortunate.
Not fortunate, you've been smart.
Very fortunate.
James, let's look through what these results were telling us. I mean, over a 10-year period, of course, 6 billion of assets and now 70 something of assets. It's been a tremendous story of value creation for your shareholders, for your stakeholders, really commendable. Just give us a snapshot of what we saw today. I mean, what were the key components you would like to share with us today?
Yeah, thank you, Elkan. It's been an interesting ride,
Yes.
very rewarding journey. And today we announced our results for last year. I think if you look at the profitability, the overall business is doing well. If you look at the private equity business,
Yes.
About 70% of our assets in the private equity business had a growth in profitability last year, which is reflected in the bottom line. The real estate business is doing well, despite what is a tough environment.
But you seem, you made the point that it's now practically debt-free, right? I mean, your
Yeah.
real estate transactions are legendary. I mean, you've taken risk on, you've de-risked, if you look at Two Rivers. So tell us a little bit about what that balance sheet looks like.
Yeah, so we have a real estate balance sheet that is about 30 billion of assets.
Yes.
And practically zero debt, because we funded it from Centum, the whole core, and we took debt there and internally generated funds. And within the next 12 to 15 months, we'll have paid up the debt also at the top. So, and we've created considerable value in those businesses, and today they are cash flow generative. So they're now able to get on non-recourse debt at their individual balance sheets without any recourse to Centum and funded from the cash flows of the business. So for example, in the last 9 months, they have had sales of the equivalent of about 5 billion. That's just on infill developments. About another 870 million on land sales. And they have a very attractive pipeline. And sort of moved the business to focus to make it market-driven development. So what does the market need? What price point can we come in to be very competitive?
So talk to me a little bit about that, because there have been a lot of stories, and the Knight Frank report came out about real estate saying Nairobi was one of the poorest performing cities. So how have you navigated what are quite choppy waters?
Yes. Yeah. So we are following the market. You understand what the customer requires, what product they require, at what price, at what location, and you provide it. And you validate it by going to market ahead of construction. And so typically we'll not construct if we've not achieved 30% pre-sales level. And for some of our developments that are under construction today, we are at 84% sold.
Wow.
Sold. So you're not then taking on market risk.
So in a soft market,
Yeah.
that's a tremendous outcome.
Then you design backwards.
Yes.
So
what does that mean?
So you design from the customer backwards. Once you identify what product, what price they need, then you design a product that fits that, and you have discipline on delivery so that there's no scope creep, there are no cost overruns, and you deliver on plan. I think the big advantage of the real estate business is that they're well funded.
Yes.
And a lot of projects get delayed and end up in cost overruns because of the funding structure of the business. So I think we built a great franchise. Look, we built it from scratch. It did not exist even 7 years ago.
Yes.
And we built it from a zero business to a 30 billion business, debt-free, with fantastic assets across the country. And even in the region, we have a great project in Uganda, Palmarina. Yeah, and they have sold over 300 units in 9 months. And it's, I was not sure the market was that deep, but that has really impressed me.
That's a big statement coming out of Uganda, right?
Yeah, coming out of Uganda. Just the power that I think we have a market that is still not served, because probably developers have not. A lot of developments are developer-driven, not market-driven. And that's why you end up with projects that are not sold.
Yes.
And yet you have a demand that is still unmet. And that's our business. And so we've expanded it to move from just the land we have to now working on joint venture arrangements with other landowners.
Which are probably cash lighter.
Cash lighter.
Yes.
But also you start off by where is the pocket of demand. And then you find which is a suitable
How
location.
do I address it?
Yeah, which is a suitable location. So this is just another input into the value creation process. And then we focus directly on going to market. So this year, we've already approved about 3 new projects in various parts of Nairobi. And you'll see a couple of developments coming up at very competitive pricing and great quality. So that's our hallmark. It's a price and quality.
So that portfolio component of the total business is what, about 37%? So you're 30, is it?
It's about 30 billion
Yes.
in assets.
Yes.
Total assets are about 72.
So it's
Yeah.
okay. So
it's about 40%.
40%.
It's
So
about
quite
40%.
But debt free.
Debt-free.
A lot of assets.
And we're not looking to put in cash into that business.
Yes.
So if anything, that business should be able to pay back some of the shareholder loans we've put in the past. Yeah.
What is the next biggest component of the business?
So we then have our private equity business.
Yes.
So this is where, our portfolio has been divided into 4 parts.
Yes.
It's been a real estate business which we developed, a private equity business which we've had but which we've built over time, a development business,
Yes.
which is where we have the greenfield large-scale developments we've been doing, and Marketable Securities.
Yeah.
So private equity is the next largest. That has done well. We've had a number of investments, we've had a number of exits, all at...
You put out an IRR
Yeah.
of what is the IRR for the private equity business?
The gross IRR of the private equity portfolio is about 28%, 29%.
And that's big.
And that was as at March 2019.
Yes.
That did not take into account the exit, the deal we just signed on Monday.
Yes.
So, and it is spread out across most of the assets in the portfolio, and a lot of it is realized because a lot of times managers put out IRRs there, they are unrealized. So we focused on a cash-to-cash, cash-to-cash IRR. That's our focus, that whatever you're doing has to be validated by the market through an exit. And we've had a track record. I think we are now on our 7th exit over the last 7 years. And we've made investments within these 5 years and exited them within the 5-year period at very decent returns.
Very decent.
Yeah.
And you were talking about wishing that you had a longer life cycle, that you looked at it for like 5-6 years.
Yeah.
And had you had the opportunity to look longer, you would prefer it. And I see you're now looking to leverage and create a dedicated private equity fund.
Yes, yes.
Do you want to just touch on that?
So what all along we've invested our own capital. And we've been direct investors.
You've had your own skin in the game.
We've had our own skin in the game. We are going to continue to have our own skin in the game. But what we want to do is to ring fence this by creating a fund structure. Centum is going to be an LP in the fund.
Okay.
The management team that has been working on this is going to be the GP. So we've sort of spun that off into a company called Centum Capital Partners, which is now registered as a GP, and we are one of the first LPs into the fund.
Okay.
And they're going to bring on board more LPs into this particular fund.
But I would have thought with those kind of returns, it's a no-brainer. I can't think of private equity returns in that sort of range.
Yeah, it's a no-brainer.
You must be in the top percentiles.
And you see our focus is on East Africa, where we have a good understanding.
Yes.
And our focus is where we are a strategic partner.
Yeah.
To businesses of some degree of scale. So we are not looking at startups, greenfields. We're looking at businesses that are looking at either expansion capital, growth capital, or where you're actually restructuring the balance sheet. We've seen great business go into problems because of the wrong capital structure. So, and I think there are a number of opportunities, especially in this market environment.
You were touching on this in your presentation, where I think you said this is like a once-in-a-decade opportunity. We've seen it before.
Yeah, we've seen it before.
Cash is king. You're Buffett at this moment.
Yeah. So it reminds me of where we were in 2009.
Yes.
In 2008, 2009.
That's what I was remembering.
After that post-election violence, the market was down. And that time we were buying companies at multiples of 4 times, 3 times. We were able to deploy cash. So my sense is that given the market conditions we see, is you sort of in the last 6-7 years, it was huge growth. Valuations are going up. I think going forward, our focus is on more cash generation. So when we look at an asset and you disaggregate do an attribution analysis of where you expect your return to come from, you expect a bigger portion of the return to come from ongoing cash returns, and less from the capital appreciation. And so sort of calibrate risk downwards and focus more on cash generation, and also have more cash on our balance sheet. Because I have a feeling that we're going to see a lot of good opportunities. Bank lending is tight. A few years ago, you'd talk to entrepreneurs and banks are falling over themselves to give them capital. Today, liquidity is tighter. You saw the numbers.
So you want to be a liquidity provider in
you
this
saw the numbers yesterday or the other week. Bank credit growth is only up 4%.
Yes.
So it tells you something.
There's a lack of liquidity in the system.
There's a lack of liquidity in the system. So as an investor, you want to be in a position to have liquidity, because quality assets will come your way. And if you're able to move quickly, you have liquidity, you'll be able to negotiate good terms.
And you've put yourself, after 10 years, people know that they can knock on your door and you can make the decision relatively quickly.
I look at a decision like Gen Africa.
Yes. Tell us about that, because you obviously booked a pretty 30% IRR.
Yes.
Gen Africa, if people aren't aware of it, is a big fund management company. You bought it how many years ago?
We bought it in 2015.
Yes.
And I found out about it at 10 in the morning. And by midnight, they had a binding offer.
From you?
From us.
Wow.
Same day.
Yes.
And the following day, we shook hands and we moved to DD and documentation.
Yes.
But you're able to do that when you have liquidity, you have a good understanding of the market, and that's where we are going to be.
Yes.
And we want to be in that position where we can make decisions very quickly and be able to act on them.
Before I move on, can I just go through, what that private equity portfolio really looked like? I mean, from my understanding, we had a lot of bottling.
Yes.
You've just sold that, right?
We've just sold that.
19.5 billion.
Yes.
Purchase price 3.5.
Yeah.
But it had been marked up in the balance sheet to about 16.
Yeah. This balance sheet was 16.
Yes.
The September number, it was at 13.8.
Okay.
Yeah, so we've signed an agreement to sell at 19.5. So it had bottling in there. It has bottling in there, and those bottlers, we merged several bottlers, created them, put them together. We were a minority shareholder, so we then bought out a number of the smaller minorities to achieve the merger, and then we put in more capital into the business, so that it could invest and grow. And Almasi has had an almost 4x growth in EBITDA in 4 years. Wow. Largely brought in management.
These are companies who should have floated on the stock market.
The challenge, Alkan, is that the stock market today, if you look at the valuations and the liquidity,
it's not there.
It's not there. It's not there. You'll not realize the real value, unfortunately, through the stock market. But that's an opportunity.
Yes.
Because today you'll go to the stock market. I was looking at Safaricom, and they're an EBITDA of about 7x.
Yes.
You will not get that in the private market.
Never.
Yeah.
But that's an unusual situation, right?
Yeah.
There are not even other telcos that are able to extract that valuation.
Yeah. So today, the stock market is a good place, I think, to buy.
Yes.
To buy.
Yeah.
Not to sell through.
Yes. There's good value there.
There's good value there.
I think average P is 11.
Yeah, as a buyer.
But within that, you've got these huge...
Dividend yields for some of the companies
you
are
were mentioning
9,
the 7-8%.
9. I've seen some 10% in there. So
that's a big buy signal.
I think that's a big buy signal. So there's still opportunity, not just on the stock market, across the region. I was talking to my colleagues and I was looking at...
Because of course you now actually, it's not just East Africa, right?
You look at the whole continent. Egypt yields on fixed income securities.
Oh, that's my trade of the year.
Is it 16%?
That's my trade of the year. Because I think everyone is overestimating the risk of the currency.
Yeah, and the currency is already devalued.
Yes, that's right.
The currency is already devalued.
That was a trade. I agree with that.
The currency is already devalued. So you have pockets of opportunity. Because there's, I think the risk aversion has swung the other way.
That's right.
So there's opportunity there. So we are likely to allocate more capital to marketable securities. But when we talk about marketable securities, it's just the NSE.
Yes.
It's across the continent. It's looking at various fixed income opportunities across the continent.
Let me come to that, but let me just finish off with the private equities businesses. I mean, I remember admiring your success with Two Rivers.
Yes.
Because, I come from a background where you take a bit of risk and you want to be rewarded for it. If I looked at Two Rivers, you got into that, you laid off your risk, you basically made it a free investment once Old Mutual had stepped in.
Yeah.
But listening carefully to what you were telling me at that presentation today, I got the impression that those were more trigger happy days, and you are looking to be take less risk.
Yeah.
Is that the correct takeaway?
Yeah. So our risk appetite has definitely come down. It was necessary when we were smaller. When I took over leadership of the company, 6 billion shillings, 10 million shillings of cash, 180 million shillings overdraft.
Is that serious? Are you
Yeah,
serious?
I still have my.
That's what you mean?
Yeah, I have my annual report for.
You probably made that presentation at Mindspeak with
those
those numbers,
those
right?
are my numbers, yeah. So to scale up, what we needed to do, in fact, one of our strategic objectives in Centum 2.0 was to scale up, because we're a small company. Now we are at 70 billion. $75 billion of assets, $700 million.
Yeah.
So we are a reasonable size. So even if you generate a 20% return a year on total assets, on an absolute basis, that's about 14 billion shillings. That's a decent return. You don't need to take on, unless, and remember now, you're taking, because of the size, you're also making bigger ticket transactions. So if the downside is also bigger on a per ticket basis. So we've scaled down risk. We've scaled down expected return, because we want to give our investors a more consistent business, where today our net asset value, book value of shareholder funds is roughly 52 billion shillings.
Yes.
The target is to take it around 100 in 5 years, so double. If you achieve that, and then you narrow the gap on the price to NAV, today our market cap is $180 million.
Yes.
This transaction we've just done is more than the market cap of the whole company.
That's a crazy anomaly, isn't it?
Yeah, makes no sense. Yeah.
So you made this point. You made this point that you want to narrow the gap, right?
Yeah, because the gap is ridiculous.
It's ridiculous. But what's your strategy to do that?
So what we have to do is several things. I think we have to explore the share buyback.
Yes. So this is where you'd be coming and saying, this discount's way too wide. It makes sense for us to buy our own shares.
To buy our own shares.
Yes.
We have 660 million shares outstanding. Have a program where every year you come and mop up those shares. Because the good thing, we have a core base of shareholders who have been loyal to the company for a long time.
Yes.
And they're not getting sufficiently rewarded, because then you have a small minority of traders who will buy and sell at any price.
Yeah.
So those are the shares we need to take out of the market.
Yes.
Buy them out, remain a listed company, but remain listed at a price that reflects value. So should our shareholders, our long-term shareholders, wish to exit, our desire is that they get full value for their investment. Today, if they wish to exit, they will not get full value on their investment. So I think a share buyback program will be helpful, and that's why it's important to pay down our debt. Because today we are spending close to $20 million on interest service only. If the $20 million was going into the market every year to mop out shares,
you would be moving the price.
Yeah, we'll clear the overhang.
Yes.
You'd
actually narrow it very quickly.
We'll narrow it down very quickly. So I think where we are going, it's actually possible to narrow it down. And therefore, then as you grow NAV, you then have a price moving in lockstep with NAV, which is where we were the correlation between our price to NAV broke about 6 months ago.
And then it started to widen.
Then it started to widen because NAV continued to grow. But I think the market was saying, we expect your NAV to come down.
Yes.
So the market expectation on the price is that we don't expect your NAV to grow.
And then that's widened.
It's been widening because our NAV 5 years ago was 39 shillings.
Yes.
Today we are 33. So what the market was telling us at the price is that we actually expect your NAV at best to remain flat or to come down. But we've actually done the opposite. So in a sense, maybe we've also surprised the market.
But you've been counter-trend to the market in a way, right?
If
you look at what's happened at the market.
The markets have come down like this. We've continued up like this. I meet analysts, they say, how are you valuing our private equity portfolio? I think if you look at all the deals we've done,
Yes.
they are huge.
You actually been conservative.
Yeah, huge
If
premium.
you look at what the
Yeah.
you know.
Yeah, and they are, and you know, so it shows that the numbers, the balance sheet is actually conservative. Even the 72 is actually a conservative valuation. Yeah.
Let me now turn to, I think, the third component of the portfolio you're talking about, which we started by touching on, and your favorite trade being Egypt, this marketable securities. Now, when you first came in, of course, you were the other way around, weren't you? Your marketable securities was the core portfolio.
60-70% of the
60,
portfolio.
70, and you deliberately made a decision
to take it down.
to take that down.
Yeah.
And what I heard today was you want to move that more into fixed income, which I suppose is less, it's less beta in terms of the returns.
It's a liquidity story.
It's the liquidity story.
You want to have access to liquidity.
Yeah.
You want to have access to liquidity when you need it. You want to be able to generate liquidity and to deploy that liquidity. And there are huge pockets of opportunity today. Valuations are low. I think there's a limit to how much further they can come down.
Correct.
So the downside risk is relatively low. From an asset allocation perspective, we should have about up to 20% of our assets in marketable securities. Today we are at 5.
Oh, is that all?
Yeah,
Yes.
it's very
yes.
small.
Yeah.
It's about 3 billion
Yes.
on a 70 billion portfolio.
Yeah.
So we have room to take it all the way to 14
Yes.
from 3. So even even if we add another $50-100 million,
Yes.
it will still be less than 20% of the overall portfolio.
So you got room to grow that.
We've got room to grow that portfolio even from an asset allocation. So you have room from an asset allocation perspective. You have room from an opportunity perspective.
Yes.
And thirdly, you have room because you now have the capital to deploy
Yeah.
to that particular
What
portfolio.
I'm hearing from you
Yeah.
is you've got your ammunition and you're ready.
Yeah, waiting for the opportunity.
Yes.
Which
is an ideal situation,
Yeah, it's an ideal situation.
in an illiquid moment, right?
Yeah, in an illiquid moment.
You are liquid.
We've been positioning ourselves for liquidity. So the number of more deals we are working on, I can't disclose now. You know, last time I told the market we are working on a number of deals. This was one of them. This we've been working on, the one we announced we've been working on for 2 years.
Yes.
Actually, I met the buyer and the first time we had this conversation was 4 years back.
Why is it taking so long then?
Exits take time.
Yes.
Exits take time. So none of these things happens overnight.
Yeah.
They take time. These are large transactions. So
But you know, what I've noticed amongst private equity firms is they always complain to me and say, we can't exit, there isn't a good exit. But you've made a lot of more exits than the average private equity fund that I follow.
Yeah.
Is that, what's the trick?
No, the reason is you have to start with the end in mind.
Yes.
You have to figure out what does it take to exit, who is my potential exit partner, and how do I position this company to be a deal for that exit. And that becomes your value creation strategy. And you work towards that. So even from a portfolio review perspective, it's like you are reducing the due diligence issues progressively through the board committees, through everybody else. So then you have a quality company. So for example, today, I have business review meetings with each of my portfolio companies, each one of them once a month. Once a month. So we are tracking, you're not waiting for board meetings, you're tracking progress, what needs to be done. Because when you have a quality business and you're in a quality, it's not difficult to exit.
Yes.
When your business is low quality business, it's very difficult to achieve that, that exit. So that's what we've been doing all along. We always have to have the end in mind. You're having these conversations, you're figuring out if I was coming in as an investor, what would concern me, and your role as an owner is to resolve those issues.
Yes.
Yeah.
But in terms of the degree of oversight and involvement once a month tells me that's probably more than most companies sitting in your position would be doing. So you're much more hands-on.
So we are involved, but there's a trick here. You don't want to get into management.
Yes.
Because our parenting strategy is that these companies should be independent. Because when you exit, you don't want a discount on account of a buyer saying, I'm taking a risk because the person who was driving it has left. So you're actually oversighting them to ensure they are getting more independent, making the right kind of decisions, and holding management accountable at a level of detail, and also supporting them. So that's sort of how involved we get. We don't want to run the business. we want to create the structures in the business to bring in the right management team to enable the company to run itself.
That's a very good philosophy.
Yeah.
Yes.
If we have to go there and run the business, then we have a fundamental problem. So that's not even a candidate for exit. You actually have a fundamental issue, and the solution is not to run it from your headquarters. The solution is to fix the structure inside. Spend time fixing the machine so that it works. Once it works, then you can work on and then growing the underlying drivers of value. Because you have to do two things. You have to grow the drivers of value and you have to reduce the risk. So when you do those two things, what it does is that you get margin uplift.
Yes.
So, for example, in Gen Africa, we came in at 1.2 times assets.
Yes. What did you?
1.2%.
You sold.
We exited at 1.7%. So there's a margin expansion.
500 basis points.
Yeah, because of risk reduction.
Yes.
And the driver value there is assets under management. So we moved from around 90 billion shillings to around 200 billion shillings.
During your time.
During our time.
Yes.
So those are the two things you're focusing on.
Yes.
So you have to reduce the risk and you have to grow the driver.
Grow the
So if you look at a company like Almasi,
yes,
the drivers are EBITDA. So you have to move up earnings before interest, tax, depreciation and amortization. So we moved it from about 600 million shillings to around 2.4 billion shillings.
Wow, fourfold.
But then reduce risk.
Yes.
So moved the margin.
So you're getting a double.
Yeah, you move the EV EBITDA, enterprise value to EBITDA ratio from around 4 times to around 10 times. But that's a risk reduction.
Yes.
You've consolidated it, you've reduced the risk items, you've reduced now you run that through your internal audit processes, your risk committees, make sure you've reduced the REDs, recurrent items have come out. So then, even if you ask us for warranties, we'll give you because we know the thing is clean. Yeah.
Yes.
Yeah, there are no tax issues. You've sorted out your compliance issues. That's a business we're in. Yeah.
Understood.
Yeah.
What is in that 3 billion of marketable securities right now? Before I go to the next,
it's a mix of things. I think 60% of it is already in fixed income securities.
Okay.
About 40% is in equities.
Yes.
And
so Longhorn is a big stake.
No, Longhorn is in private equity.
Longhorn sits, notwithstanding it's a listed security.
Yeah. Because we are the ones who took it to market.
Yes.
That's a private equity
Okay,
business.
I remember.
Yeah. So this is a mixture of marketable security assets and fixed income securities.
So we've gone through 3 of your components. What's the 4th?
So the 4th is development. So development.
Yes. What do you mean by development?
See, these are large greenfield ventures we got into.
Would Lamu be under?
Yeah, Lamu is there.
Yes.
Amu Power, we have an exposure of $20 million there.
Yes, that's the limit of your exposure.
Yeah, that's the limit of exposure.
Lot of press swirling about it. I mean, what is your perspective on this? Because I see a lot of pushback on the whole coal thing. And
yeah,
but GE, they took an equity stake, right?
There's pushback because of a global environmental concern.
Yes.
Around coal, okay, and that's understandable. There's been a lot of agreements signed and things like that, but also the coal generating industry, the power plants, have also done a lot to mitigate the environmental hazards of the power plants.
Because I saw GE have a very unique name. It was something like clean coal.
Yeah, they have
it was assuming that they were going to be able to do the science.
Yes, so they have technology today.
Yes.
Where the emissions have come down considerably. So we're looking at the guidelines, the World Bank 2017 guidelines on coal power plants, where you should be. First, a lot of power plants around the world are way above those guidelines. But where we currently are, like the technology that is proposed for Lamu, on each one of them, because the issue with coal is dust, it's carbon dioxide, it's sulfur dioxide, it is NOx, it is mercury and arsenics, and on all of them, they are way below the 2017 World Bank guidelines in terms of what the emission requirements are. But the big advantage of coal is the cost of power is very low. The variable cost of the power is very low, and it's base load. So what it does is that it displaces a lot of more expensive base load power, because today our base load power is largely HFO.
Yes.
You have
heavy fuel.
Heavy fuel. You have hydro, but that hydro is not reliable because of our hydrological conditions. You have geothermal, which has increased. We also have a geothermal project called Akira.
That one is where?
Yeah, it's in actually just next to Alkari.
Is that another development?
Another development.
Yes.
But that takes time. Those take time to come through. So this plant is going to displace a lot of HFO power plants that are today sitting in baseload and allow more renewables to come in. Because the challenge with the renewables is that
They're not baseload.
Yeah. So you need a certain threshold of baseload to support their intermittent power. So whether it's solar, it's not available throughout the day. If it's wind, it's up and down. So you need a baseload threshold. So I think there's, I've engaged with a lot of my friends who are in this debate. So I tell them, okay, show me the numbers. What's your concern? What would you like the plan to reduce further?
Yes.
I want to explore with the team.
But
they're not able to come with anything tangible. Yeah,
yes.
They just say, okay, no, this thing is not good.
But there's a lot of
there's a lot of
consistent. Like yesterday, somebody put out a report. I don't know who from,
Yeah,
saying you're going to be the most expensive power.
Yeah, I saw that. I say, but how do you?
They're not engaging you.
No, actually, somebody forwarded me the.
You know what I'm talking. I saw
the report on WhatsApp.
Yes.
So I'm also reading it now.
Yeah.
No, they didn't engage us.
Yes.
They didn't ask us what the assumptions were, and there would have been nothing easier than to have engaged us in the process. And we also read it like members of the public.
Yes.
Yeah.
So you got the power. Is that?
So we have that one.
Yes.
And we have Akira.
Yes. Geothermal.
Which we've partnered with a company called Frontier.
Yes.
And that's a geothermal business. And now we've partnered with Kengen.
Yes.
So Kengen is now doing exploration, and we're going to work with them on the drilling program.
Okay.
Hopefully, once we progress, also maybe on the operation.
Wow.
Of the power plant, because just next to their plants.
Yes.
So we have a very good working relationship with Kengen.
That's interesting, because they're also looking at geographical expansion. That might be an opportunity for you to follow them.
Yeah. But look, these projects take time.
Yes.
That has been our lesson. We are a very evidence-driven organization. What does the evidence show? The evidence shows that these things take time. There are a lot of factors that are beyond your control, and those can be very highly return dilutive. We are still carrying these assets at cost. We've not booked a single shilling of return on them. So that time value of money has been compensated by higher return on the other segment of the portfolio. Therefore, the conclusion that we don't want to deploy more capital into greenfield ventures of this nature. So we are unlikely to see us making new capital deployment to greenfield ventures of this nature, largely because of those factors. For us, time is very important. Certainty of process is very important. The real estate business, you're in control of the process. This project, you're interacting community, government, whatever, all these actors. They
herding cats.
They come in and you had a program and you can't meet that program, and that dilutes your capital. Fortunately, the exposure was not big, because the total exposure is 5 billion shillings on a 70 billion portfolio. So it's 5%.
Yes.
5-6%. Yeah. So it's a risk we can tolerate, but we cannot tolerate it at a higher. It's not consistent with where we want to go.
Let me come now to the actual earnings you reported. Profit after tax up substantially.
40%.
40%. Earnings per share up similarly. Dividend flat dividend. Why was that?
It's because this year we are prioritizing the debt repayments.
Okay, so you want to pay it down.
So we'll have a huge cash outflow
Yeah.
as we pay the debt. So that's the first priority.
Yes.
Pay out all the debt. Then you're able to sustain the dividend.
Yeah.
Because the dividend is going to be paid out of the net cash annuity income.
Yes.
Today the net cash annuity income is reduced by the debt service.
Okay.
So you have to sort out the debt first and then sustainably increase the dividend.
Okay.
Yeah.
Asset size we've already covered.
Yeah.
So overall, when you look at this machine you've built over these more than a decade, are you happy with where it is? Is it optimal now? I heard a very confident CEO up there.
I'm confident. The question is, am I happy?
Yes.
Of course
Are you happy?
not.
You're never happy.
Of course not.
You're going to tell me I'm never happy.
Of course not. I'm never happy. I'm never happy. We could have done better.
Yeah.
When I look...
You could have done better.
Yeah.
I mean, look at it. It was an annus horribilis in the stock market last year, right? I mean, you've done significantly better.
We made some mistakes. We've learned from them. You always have to have that hunger and desire and feeling that you could have done better to continue to grow. So always trying to improve the machine. But I'm happy about the trend we are on.
Yes.
Yeah. I think given the cards we've been dealt with, the way the environment has been, okay, was there more you could have done? I'm not sure. I think we've really put in our best effort out there. So I'm happy with the effort we've put in. I'm happy with the direction we're going.
Where do you want to be in 5 years' time, James? 10 years ago, you told me where you're going to be today, and it's a really incredible feeling to be sitting in front of you and hearing you tell me all this. Now,
I think in 5 years' time, Centum will be $1 billion plus organization.
From 180 market cap?
Yeah.
$1 billion market cap or $1 billion?
I think we can get to $1 billion market cap.
Yeah.
Because if you are at $1 billion in assets and you're generating a return of 20%,
yes,
then you're giving real value, and that return is largely cash. I think investors were discounting our ability to achieve these realizations.
To achieve those sorts of extraordinary returns. They were discounting, saying they can't keep doing that.
They can't keep doing that.
Oh, look at that.
So now they don't have to worry because these are largely going to be cash returns. I think we can be $1 billion plus investment company. Very strong balance sheet. I think the idea is to be a AAA rated organization. Very strong institutional structures. That's what the phase we're going through now. We've had an entrepreneurial phase.
Yes.
When we drove it, when we did different things, we're now going through an institutional phase where there are various pillars, clearly run businesses with system structures, sort of proper governance. Centum should be able to spawn out large entities on their own.
Yes.
So whether it's our Centum Capital business, it should be a big company on its own, or our Centum Real Estate business, possibly might even be a listed entity, Marketable Securities business. And we should be an influential equity player in the most important sectors of our economy. I think Centum will be in many of the
Pan-African.
Yeah. I think 5 years, we really need to be really strong in East Africa. I still see there's a lot of opportunity. You know, when you're an equity investor, particularly a private investor, you need to invest backed by real knowledge and ability to influence within your local context. So I'm not sure about the Pan-African, because then local knowledge
you have is so much.
We have here.
Gives you a bigger competitive
advantage. Give us bigger competitive advantage. If our portfolio company has an issue, we can sort it out.
Yes.
If our portfolio company today has an issue in Nigeria, we don't understand it well enough. We don't know the people. Here we went to school with them. You know somebody. You're 2 degrees removed, whether it's in Uganda, wherever.
That's an interesting.
You can sort out issues, but there, you know, you don't know the people. You don't have a relationship. And at the end of the day, this business is a relationship business.
It's a relationship.
It's people, because people drive the business. The numbers are the outcome of people. And if you don't know the people, you don't know the context. So today we are not, I think we can be really strong in our market. We can be a champion within East Africa in 5 years' time. That's the objective.
Thank you for making the time.
Oh, brilliant. Always a pleasure. Invite me to MindSpeak.
You MindSpeak, you've got to come on our Metropole show.
Yes, Metropole show.
In the evening. Yeah. We'd love to have you.
It will be a pleasure.
And really look forward to that.
It will be a deep pleasure.
I'm very proud, James, because
fantastic.
having seen somebody tell me that this is what they're going to do, then to watch them do it.
Yeah, you know, having that clarity of vision and the discipline.
The clarity and discipline. And you took risk.
Yeah,
you were also a trader.
Yeah, take risk.
When you saw it, you took it.
Take calculated risk, but remain true to the vision.
But what I hear now is you're a Buffett. You want cash, but you can afford to be.
Because now we are, we are larger, but you see yourself to be flexible to the market environment you're in. You can't remain pedantic to what you're doing. You have to say, okay, what is the best play under these circumstances? Because you have to make a return regardless of the market environment.
Yes.
You know? So under the circumstances, you have a different playbook. If the circumstances change, you change your playbook. So, and we've seen it, you know, the first cycle, the markets were very tough. We were provider of liquidity those days. We were one of the first to get into the repo market, giving liquidity to banks.
Is that right?
Yeah. In 2010, 2011, we were doing a lot of that. We had quite a bit of liquidity. Then we went to a boom.
Yes.
Then we were there participating in that. Then you're sort of here, you're not sure how things are going to go. So again, so it cycles, and you have to be able to as a captain of the ship, it has to navigate.
Understand the cycle.
Yeah, understand the cycle you're in.
And also empower them.
Yeah, and empower, and then.
And I must commend you on that, because I came to make a presentation to some of your portfolio managers about 6 months ago. and I was looking at everybody there, and I kind of thought there are 30 little Jameses here being coached.
Maybe even they are better.
which is the right strategy.
Yeah, that's the right
I think it was called the turtle strategy by a trader famous many years ago.
Yeah, that's the right strategy. So you take away the key man risk.
Yeah.
Yeah, people all doing their stuff, they're clear what they're meant to do. So I'm happy that today, clear succession, we've reduced key man risk considerably. And this institution will carry on long after probably we've left the scene. Yeah, we institutionalized it. Yeah,
that's
long after we've left the scene, it's not reliant on us, on the current generation of leadership. Yeah.
Excellent.
Brilliant. Thank you.
Thank you.
Fantastic. Thank you.